Welcome to Blue Margin's Expert Insight Series. This series was established for mid-market executives and PE firms looking to use data analytics and dashboards to put growth plans into action and increase the value of their companies. Today, we have the pleasure of welcoming Sean Edmonson from Tecum Capital. Sean has been with Tecum for 5 years. He's also a board member for BP Express, Connecticut Electric, FSC Lighting, National Power, and FNS Tool. Tecum is a PE firm operating out of Pittsburgh and founded in 2006. They invest operationally in lower middle market companies with strong management teams, almost always entrepreneurs, typically in that 10 million EBITDA range and under. They've invested close to $1 billion to date. As a VP at Tecum, Sean takes the lead on investment activities, including sector and company analysis, performing diligence, negotiating debt financing, and working with portfolio management teams. Prior to joining Tecum, Sean worked within the industrials investment banking practice of Brown, Gibbons, Lang in Cleveland, and he also worked in the commercial banking division of Wells Fargo. His experience ranges from strategic advisory, sell and buy side advisory, raising capital across the middle market for both private and public companies. It's great to have you here today, Sean. Really appreciate you joining us.
John, thanks for having me as well. Really appreciate it.
Yeah, you bet. So, Sean, we're excited to have you here to talk about operational excellence, which I know is a cornerstone of Tecum's strategy. Tecum, as I understand it, means with you, which I think speaks to fundamental philosophy in your approach to working with portfolio companies. I wanted to ask about the resources and support that you provide to your management teams. I know that having strong, empowered leaders is really an essential ingredient for how you view success in these investments. Can you talk a little bit more about the ways that you support and empower those teams?
Yeah, of course, John. I'd be happy to. And I think just to kind of dive in on a point too, maybe talk about like the maturity or life cycle of some of these companies and maybe their philosophy, given that many of them are, let's call it 3 to 10 million of EBITDA, family founder owned. I would say more often than not, these successful companies, maybe at times at the point of sale when we're getting involved in partnering with folks, is oftentimes just because they feel as though they're hitting a glass ceiling or maybe trying to de-risk. And I'd say more often than not, kind of the cornerstone of a lot of these companies is really good culture and some tenured employees, but often maybe falling short on scalable, processes, leveraging technology alongside kind of more established processes. And then I'd say, especially as it pertains to people relating to, I'd say kind of a repeatable process around recruiting, training, retention, and continuous development. So I would say, where we kind of start oftentimes when we get into our companies and some of the resources we provide is, we have a lot of background and experience in helping our companies build, training programs, and really kind of, I'd say, systematize kind of their recruiting process and how they go about retaining talent, just given more often than not, human capital is a major, I'd say, value driver of a lot of our businesses. So I'd say on that front, that is definitely a key staple with us, and as we've added folks onto our team that don't come out of traditional industry, like Dave Bombanuto, for example, he built one of the largest apprenticeship programs in the state of Pennsylvania. So leveraging expertise like that. On the process and on system side and resources we bring, for our size firm, we go to market as a lower middle market fund. We don't have a full captive, operations team. So we do have kind of best of breed consultants that we leverage. But I would say kind of at its heart, where we always focus before you go through a money of problems is really understanding process breakdowns. As it pertains, whether it's a manufacturing company, a service company, or a distribution company, and really hone in on, documenting those processes and understanding where those constraints are. And then ultimately, kind of when you get to a point where you have a good processes in place, leveraging, technology appropriate for the company. And that's really kind of some of the core tenets of, how we oftentimes get our investments off the ground in the early stages. Um,
Yeah.
and really kind of, and probably more so for the theme of the discussion. I mean, technology, we love to leverage it. And I think the key part is you got to get your processes right to be able to use it appropriately. So,
Yeah. And having those processes mapped, ultimately, I assume you're looking for where are the points that create value. How do we measure those? And then how do we surface that to create accountability and focus and keep top of mind awareness around those? Is that part of the process? Is once you've mapped the various processes, documented them, really understood them, cleared out points of constraint, then is it about measurement and feedback at that point?
spot on. Yeah. I mean, and I think that's the biggest thing because oftentimes it can be an emotional discussion when you're challenging a long, established process. And then it's like, well, where are our pain points? Why are we winning? Why are we losing? And then let's start measuring, frankly, those things. And I'll give you an example. Today we were talking with one of our CEOs in a new platform we just closed on, and he's saying a key constraint for us, or maybe why we're not converting as many leads as we'd like, is there's a delay in how fast our sales folks are getting in front of customers from the point a lead is generated. So it's like, well, let's make sure we're measuring it, prove it out, and then we can start to really kind of prove whether or not that is indeed, a fact. And that's a really simple data point, but it's powerful as you kind
Yeah.
of think about
Yeah.
throwing money at challenges or issues in a business. More oftentimes it's let's evaluate the process first. It's not just hire more people and buy more equipment.
Yeah. Well, you've touched on something there. A big part of the value that we try to bring to the market or to our clients is elevating a culture of accountability. But we find that you can't hold people accountable unless you empower them as well. You can't just dictate, especially you're talking a founder, operator, going in there like a bull in a china closet and saying, here's how things should be done. I imagine you may have tried that. I imagine it hasn't worked. If you have, how do you keep the operator, the founder, empowered, engaged, and still improve their processes, make tweaks, redesign sort of the model where needed to improve outcomes?
Yeah, that's a really really great question. I would say over the years, admittingly, we've gotten much better at this, but as we've kind of honed in on the how, of empowerment, it really just comes down to getting alignment early on in the investment. More often than not, as we alluded to, or as I alluded to, we're bringing in key folks as well to assist, teams where maybe there's kind of deficiency of talent, or maybe just historically hasn't been an area of focus. And at the onset, I think maybe one thing that is unique for us is we don't give false advertisement or representation of, hey, we have this unified playbook that we're going to run that's going to create all this money. I think we have the utmost respect for a lot of these businesses and different industries, and there's not a unified playbook that works on these companies. So more often than not, we're working hand in hand with our executive teams to really kind of form the pillars of that value creation plan over the course of the investment, and really work our way back. I mean, where do we want to go in 5 years? And then what are the steps you got to take there in kind of the next 12 months, the next 36 months, and then check and adjust along the way. And back to kind of empowerment, you gain that alignment early on with your team, really kind of challenge, let's say, kind of the needle movers in that plan. We create a strong cadence with that team, and then we empower our leadership to check in with us as we work with them. And admittingly, I mean, we have a finite amount of time, just as much as they do. We can't be at these companies, 24/7. So really what we're looking from them is, hey, if we're all aligned on the onset, it's your responsibility as the executive team to come to us based upon areas of expertise we have, where you need us to help you guys scale and go execute. Otherwise, we're assuming based upon, measuring and driving that accountability that you're going to drive the plan. And I think
Yeah.
folks really appreciate that because ultimately folks they don't want to be handcuffed or have folks sitting, in the ivory tower telling them how to run a business when, ultimately that's not my job and that's not what we get paid to do.
Sure.
And I think there's just a mutual respect, and that goes a long way in terms of kind of establishing that trust and ultimately that empowerment that they feel to go get things done.
Yeah, that's great. I want to touch on that point of alignment and trust. I think PE firms of old were more dictatorial and found that that did not work well. They, like all of us, are looking for what's that formulaic approach. It sounds like each one of your engagements is very custom, depending on the company and the makeup of the people and so on. That's similar to us. It would be great if there was a stamped approach to doing it, but that tends to only fit a very small percent. So getting that alignment with your management teams, we find that alignment and trust fails when people don't know what's happening. So even though you're trusting them to execute and trusting them to come to you when they need expertise, if you're in a fog and they're in a fog, that invites scrutiny, that invites micromanagement, that invites a lot of questions and a lot of ad hoc phone calls and meetings and PowerPoints and Excel spreadsheets and so on. How do you maintain that alignment so that you don't end up in that obtrusive position?
Yeah. And back to the size of our companies we're investing. I mean, oftentimes what we're starting out at is really just kind of understanding, most data in our world, and it's a challenge, is laggard data, right? And I'd say more oftentimes than not, you're at least a couple days behind, best case scenario. So, tools that we leverage oftentimes here, is we're looking to leverage, business intelligence tools and understanding kind of where there's real-time data that can help us make decisions within a couple-day lag, and oftentimes trying to establish those dashboards and reporting KPIs early on. But there's definitely you got to strike a balance of what is, I'd say, functional information that we can use to both drive accountability and make decisions, but not inundating a management team with just kind of this data proliferation exercise. So admittingly, I mean, that is where we always try to get on with our companies. And I'd say more often than not, we're introducing, I would say, weekly KPIs and kind of scorecards, if you will, for the first time. And it can be a major culture shock to them. But ultimately, what we find is folks that kind of want to operate in that environment of empowerment, they like having that accountability, and that, frankly, that builds that trust. So,
yeah, that visibility is empowerment. Not being able to see does not put you in firm footing in a sense of empowerment. We found is sort of the premise of what we do. Do you have something of a formula in the first 100 days to get an OKR dashboard in place to make sure the value creation plan is sort of memorialized and being tracked at a high level? How do you go about that? Or is it more ad hoc depending on what the acute needs are at a particular company?
Yeah, I mean, obviously it varies by industry, right? Especially, there can be a bit more complexity in a manufacturing environment than there is oftentimes in a service environment and or a distribution environment. But I'd say we really, out the gate, really just get down to kind of a basic dashboard of tracking our value creation plan and responsibilities at the company, and then who is assisting on the investment team to drive that execution. And then oftentimes too, back to, working on those dashboards, we're trying to figure out with a team, well, what do you have now that can drive or influence decision making, rather than, Rome is not going to be built in a day, so let's not even attempt that. But let's understand kind of where there's good data points you guys have, or we can really start working off of a concrete set of facts. And you kind of combine those two, and it can be a really good recipe for success. And then what we find oftentimes is, you get a good cadence with that team, and then you go into kind of your first, budget, phase with folks. And you really start matching kind of that your dashboarding with your budget. And then ultimately they see how it ties into the vision of the company. And that can be really, that's the recipe for success, when everyone sees kind of how that compounds into the ultimate goal where you're working.
When you're establishing those early KPIs and surfacing them, first of all, what tools do you typically use? Is it usually Excel, or using a BI tool like Power BI or Tableau or something?
Yeah, it depends on the sophistication of the company. I would say what we've been finding as of late, especially with the cost of BI coming down substantially over the last couple of years, and the applicability of it, we've more often than not been shifting data sets into Power BI, just because most of our companies, for better or for worse, run on Microsoft licensing, and it's just built in. So oftentimes we'll bring in some outside consultants to help build them, And then, sometimes you'll have some kind of talented folks in-house that can help build it. But, more often than not, these companies are not 30, $40 billion EBITDA, firms. So it's a combination of us assisting and then bringing in some outside expertise.
And do you find that there's a lot of manual entry up front, or are you typically going right to source information or exports of CSVs and Excel from transactional systems when you get started?
With our size companies, I'd say more manual in nature.
Yeah. And is that, I assume they're inputting into Excel typically?
Yeah, it's spot on.
Yeah. Yeah. And then over time, are you connecting Power BI directly to data sources or using a data lake or data warehouse and then connecting to that?
Yeah.
Or is this not your purview?
Yeah, the latter is typically where we're going. And there's some good BI tools we're finding too, in some of the new ERPs out there, like Acumatica, for example, has a lot of powerful BI tools that are embedded within their system.
Yeah. It's interesting that overlap, the Venn diagram of reporting that comes directly from a system like Acumatica and Power BI that will take data from different systems and combine them. We use HubSpot here. We use QuickBooks. We've got various systems. We use the reporting out of those tools, but then we also load everything into Power BI for deeper analysis and sort of that company view of things.
Yeah.
Do you find that dividing line challenging between reporting directly from the system and saying, we need to put this in BI? How do you deal with that?
You're going to laugh.
Have I gotten outside your expertise?
No.
Okay.
I would put it in an expertise area, but I would say functionally, we have a lot of experience here. It really goes back to that empowerment with your CEO and your C-suite, because more often than not, what we're finding is, here's what we need to see as we all get aligned, as we have that alignment. And then more often than not, the CEO is saying, well, for me to do a better job of managing the company, they're working with the CFO and driving them down the decision making and saying, well, we can't have these huge lags in getting information. And what do you need to be successful here? So ultimately, us as a team can make, I'd say, more efficient decision making. And then that's kind of where we get that introduction of, well, do you just start using a BI? Do you have, kind of embedded BI tools with certain systems? But I think, one proliferation that we're seeing more often than not too, especially with acquisition strategies, is obviously you have disparate systems, and then it's more of a necessity out the gate to get everything through kind of a unified, BI overlay. Yeah. And that's probably in our life cycle. That's where we're probably in the early stages of, I'd say, really kind of mastering that exercise, because it is like some people get inundated with this obsession around having one ERP on businesses out the gate when you do acquisitions, and it can be really disruptive and a huge waste of money, frankly. And before they kind of just get their full integration plan, let the system run parallel, and then maybe integrate 6 to 12 months out.
Yeah. We concur with that philosophy. If you wait for that integration, that can really grind things to a halt. If you can consolidate at the data layer, you can keep things running smoothly and then do that systems integration on the back end. I want to keep beating the drum of data here for a second. Yeah. I'm curious how much of your success formula, I know you're sort of upper quartile for your strategy among PE firms. How much is data part of that, say, versus personal relationship? And then I got to follow on to that.
Yeah. That is a really hard question, because we've been fortunate to be a part of some really strong success stories, and I would categorize them. Sometimes it's better to be lucky than good. But I kind of reflect on that question and tell you, I think at the heart of a lot of those success stories, I would say an outsized majority have some type of central focus around data to drive decision-making and accountability within the organization. They may not spend, an excess amount of money on automation and systems, but they have reliable data and they make good decisions and they use it to drive their org. So
they know their numbers.
Yeah, that's really, I would really emphasize that at kind of our size of the market. So,
and then do you think in terms of pushing that data visibility through the organization to the shop floor, et cetera?
I would say transparency. Like I'm a huge believer in radical transparency. And I would say with some of our best run organizations, especially, where I've seen it come to life, frankly, um, is in manufacturing organizations because it's such it's a very complex operating environment, and folks, just given tolerances and throughput and some of the dynamics that go into, world-class shops, is those folks need to understand they like to be measured and they like to know what winning looks like on a given day. So I
Mm-hmm.
think more often than not, a lot of our organizations, they have that push through within certain data sets to where they understand exactly what a good day looks like and what a good week looks like. Um, so I would definitely emphasize that. And then even on the service, in the service world, I think, you know, given just the dynamics of that world, it's not as static per se as a manufacturing shop with a machine cell, if you will. But, more often than not, our best run companies, their service techs have really strong visibility with, production, goals in a given week. And they know, when they're up or down as they work kind of towards that week target. And sometimes, you have bad days, good days, just given some of the dynamics around, maybe drive time, things like that, traffic. There's things
Yeah.
that you can't
First
control.
time fix.
Yeah, exactly.
I love what you say about folks wanting to know if they're winning or not on a given day. Those are the employees you want. I know some folks are concerned about exposing performance data being like a wall of shame or some sort of sinister accountability methodology. But for those who are accomplishment driven, want to make a contribution, have agency in helping the business succeed, they tend to want to know what's the bogey I'm after and am I getting there?
Yeah, I mean, I'll tell you this on the employee side. So there's two distinct examples of that. One that we were directly a part of. One that our operating partner Dave was a part of, and one was related to we had in one of our transportation companies, we had a major cohort of drivers that just didn't drive safely, and it was just instilling a bad culture. And we took a step back probably for 12 to 18 months, but he came to the board and asked, can we terminate all of them? Because, we're not going to win these, blue chip clients with a driver base like that. And they terminated them, and then they put in a culture of accountability and data. And that, I mean, it changed it. It took some time to rebuild, but then you got the right people around the table. And we've seen that time and time again. Folks want to be around folks who want to win. And I ultimately, wherever you are, sit in a company, whether you're working on the shop floor or you're sitting in the C-suite, folks want to know that they're aligned with the people that are sitting next to them.
Yeah. Yeah, you want that winning culture. And without a scoreboard, it's tough to get the team rallied for sure. I mean, I know I'm preaching our message, but
Yep.
I believe it. And it's tough to fire people nowadays. I mean, I'm hearing this trend of acquiring companies simply for the personnel. This is a tough period right now for human capital.
Yeah. Yeah. I'll say this. It amazes me. You get into some of these companies and you hear the challenges they're having with folks, and they have no visibility on market comp. They have no visibility on, who are their outperforming employees, who are their underperforming employees. It just all kind of stems back to that culture of accountability and even how you hire people and pay people. So,
yeah. Curious if you got that phrase "radical transparency" from Ray Dalio of Bridgewater, or if you pulled that from somewhere else. I know it's not too uncommon.
Yeah, who I actually got it from is Jocko Willink.
Jocko.
He's a big believer in that, and I love Ray Dalio as well. But yeah, that's a big thing with Jocko Willink. So
yeah, great. I know that you're involved in the diligence process and analyzing sectors and analyzing companies and so on. Do you see a big difference between companies that have a grip on their data, they're wired for data, and those that are sort of seat of the pants? Does it make a big difference in terms of valuation, speed of transaction, how you view them, or is that not a primary consideration when you're looking?
Yeah, I would say it's a major consideration for us because we always look at it, from the viewpoint that if you have if let's say you're deficient in your systems and your processes and how you manage your organization, we've often found, you can throw as much money at consultants as you want, but it's really a cultural shift, and oftentimes that can be a 12 to 18-month lag between process, refinement, and then getting systems in place and ultimately getting the technology in place. And it can really kind of hinder the speed at which you can execute your value creation plan.
Yeah.
So for us, I would say, what I would say is there's definitely a balance, right? I mean, if you're a $4 or $5 billion EBITDA company, there's a balance of how much money you can spend on your back end, on the systems and your supporting personnel. But back to kind of what I was saying, and some of our successful stories is they have a really good handle on key data sources. And what I would, some of our best executives say this all the time is, if you have if you have enough information that gives you 70% of the picture and you can instinctually make good decisions off that, you're 10 steps ahead of most at that size of the
You're
market.
ahead of yeah. And where they don't, I assume for the unknowns, there's a subconscious or intentional discount that happens.
Of course. Yeah. That goes back to just having the respect for folks that have been in the industry for a long time. Is it oftentimes is instinctual, but they have a data pattern that they use to drive the core of their decision.
What's your process for assessing that data enablement? Is it standard?
I wouldn't say it's standard. I would say I've been probably early on in my career, I've been exposed to some really strong manufacturing organizations and some really bad manufacturing organizations. And I would say the manufacturing sector is, I'd say, probably one of the most data intensive industries. And I have a lot of respect for people who run those organizations because it's not easy to
Right.
do. And what I would say more often than not is within that world, really got an appreciation for what good data looks like and how you use it to frankly go and win. And more often than not, with our deals that we're evaluating, I mean, you're asking people, well, what are you using to make kind of decisions? Let's call it weekly, monthly, daily, if possible. And you can oftentimes get a really good feel for kind of the culture of accountability and systems that they use just by asking those questions and seeing what they're
Yeah.
leveraging. And that typically gives us a pretty good feel. So
Yeah.
I will tell you this: often, if you don't have any type of dashboarding or KPI scorecard that you're using with your team, it is a major deduction on value. I would say on the value of your company as you're looking to sell to
Yeah.
institutional investors as a platform. So.
Do you? Yeah, that's great. I appreciate that. Do you require a monthly board book, a standardized report?
Yeah, I would say maybe 60 to 70% of it I put kind of in that conforming or standard structure that folks just need to see, but then really try to tailor, the kind of last third of it to what we need for that specific industry and that business, and based upon the processes and data available, just to make sure that we're measuring, I'd say key commercial and operational drivers of the business.
Yeah.
So.
Okay. Let's talk about the current headwinds that I think we can still speak to as current.
Yeah.
Interest rates, increased costs on materials, logistics, et cetera. In that environment, what is Tecum doing to reduce risk today, position themselves well for tomorrow? How are you thinking about that?
Yeah, of course. I think there's a couple factors there. I mean, I'm not going to pretend to be an economist. We ironically just had our annual meeting 2 weeks ago and had a really strong economist out to present. So I'm fairly refreshed here. But what I would say, just generally, um, trending cautiously around the consumer environment, or any type of secondary consumer exposure. I think from the way we're looking at it, if there's any type of gray area around consumer discretionary or consumer discretionary impacting an
Mm-hmm.
industry, I think just treading cautiously, probably being a bit more
Yeah.
defensive. What we're generally seeing is the consumer pocketbook is really strong still, and I think we believe in that viability. But emotionally, just given kind of the noise in the market, there might be just some tightening, which obviously folks are seeing in some e-commerce businesses, things of that nature. I would say
Yeah.
generally in a lot of our a lot of our partnerships as well, and even new deals we're evaluating. New deals we're evaluating or closing on, we're really looking to over equitize those just to shore up the balance sheet to operate those businesses for the long haul. And then on existing or more tenured holdings within Tecum, I think we're just trying to get our organizations to really think about, in the event there is a slowdown, how do you manage through that? And do you have that plan in place? We kind of call it like a tier 2, tier 3, it's a tiered plan of, profitability decline and kind of how you manage that. And then the challenge is just given the unemployment rate as well, no one wants to let folks go. That's never a goal, right? Ultimately companies got to do what they got to do to survive. But the challenge
Yeah.
is that lever is really off the table, frankly, at least from our view, as you look at kind of employee retention and how tight the labor markets are.
Yeah.
So it's really trying to,
And transitory.
yeah, it's not an easy environment to operate in by any means. And the headlines oftentimes can differ substantially just from the facts and what we're seeing right now. So it's just one of those things. Is I think I'd kind of Tecum headline is treading cautiously, actively investing is if you look, but we're really focused on durable industry, and more often than not too is investing in companies where they have a strong employee base with really, I'd say moats around their skill sets,
Yeah.
more highly skilled workers, things of that nature. So,
Yeah. Aren't those the most likely to have the moats breached by recruiters?
You would think so, but oftentimes, if we always are benchmarking comp and checking attrition rates within our
Yeah.
companies. It's you identify that stuff early on. If there's a culture issue and folks don't like where they work, it's not all of a sudden going to change when we invest, right? You're probably not making that investment if there's high turnover and you're below market comp, things of that nature, or you're addressing it before you close on behalf of the employees. We're really, really big on job growth within our companies. That's a measurement for us internally. So.
Yeah, and focusing on career path and other things that are requiring extra attention nowadays.
Yep, exactly.
Yeah, interesting. Separate from headwinds, when they're not in place, do you tend to be a reasonably even mix of discretionary and durable, or do you tend towards the durable side?
Yeah, probably generally as a firm, I'd say we're probably 80% durable if I had to guess. We've done really well in, I would say, more consumer discretionary industries or industries that are more exposed to kind of inflationary pressures like building products, obviously. But I really try to stay the course, of a bell curve, if you will, with more, I'd say, kind of durable, manufacturing and services. So,
yeah. So some big PE news from last month. Biden signed into law the IRA, not what you'd think, but Inflation Reduction Act. From what I understand, this is a win for the PE industry, providing some tax relief on carried interest. Can you explain how this legislation might positively impact PE firms and mid-market companies? Are you familiar with that?
Yeah, extremely. Yeah, I'd be happy to. And I'll just try to speak to it as more of a broader audience. So generally, our industry is compensated by outperforming a general, performance benchmark. So in our world, it's typically 8%. And some of the items being thrown around in regards to the Inflation Reduction Act as a way to create more tax income was shifting rules of carried interest for let's call it private equity professionals that are allocated carry, whether it's a general partner or mid-level employees working their butts off for these companies. And some of the thoughts, generally in Congress that were floating around were related to the duration in which you would need to hold an investment for the carried interest to qualify under capital gains versus ordinary income. So just for simplicity, for a broader audience, ordinary income taxation, let's just call it the simple number of, 37, 38% versus cap gains of 20%. That was a key, discussion point. There was the major item I had last seen was, folks were trying to press for a 5-year hold versus a three-year hold. And that's what the current limit is, we have to have an investment outstanding for our carried interest to qualify for long-term capital gains versus ordinary income. If you move it to 5, I think it was the traditional hold period for a lot of committed funds is typically in between that 3 to 5. So it's disincentivizing oftentimes these really positive outcomes for both management teams and investors, alike. So that was a big driver here is they kept the duration at 3 years. They didn't mess around with the taxation. And that has been kind of a big win just with the environment. I mean, I think generally as you look across, where money is shifting and values being driven in the public and private markets, there's been a big shift into, the private equity asset class. So it's nice to see that they're still trying to maintain an incentive that rewards, groups for, working really hard oftentimes to drive, these benefits for pension funds, endowments, things of that nature that ultimately benefit employees and things alike. So
I'm sorry, did it stay at 3 years?
It did. Yeah. That was a big thing.
Is there a possible positive, not that you'd ask for this, but a possible positive outcome of going to 5 years in that it encourages more organic, I guess, honest growth as opposed to optics for, valuation and multiples? Is that a thing?
Yeah. I mean, I would say for us, and just for context, like our control equity arm is we raise money from families and institutional capital. So we don't have the committed fund pressures of having to kind of churn and burn these companies. It's something that we take a lot of pride in. And I think if you look at our website and if you know Tecum, I mean, really focus on sustainable value creation. So I kind of hear that point. I don't know what the answer is because I'll be honest, there's a lot of folks making a lot of money right now in aggressive buy and builds with companies that aren't fully integrated, a lot of multiple arbitrage. Obviously there's not going to be kind of a one size fits all as it pertains there. So I see kind of that viewpoint and I can appreciate it, but then it goes back to at the end of the day, if you go talk to maybe a pension fund or an endowment, at the end of the day, what they care about is that we're hitting the return profiles that they're allocating their money to. And ultimately you want to incentivize the private equity asset classes investors to, be driving real value in these companies, whether people perceive it to be or not. So
for economic growth is a good thing. What's your average hold period?
Yeah. I would say for us over our history, we actually were just talking about this. Our average hold period is typically right around 48 months. We tend to be
so right in there.
Yeah, I'd say we tend to be long. We tend to be longer than many firms that you see. I would tell you on the control side, our structure currently is in place. Not that we want to force a short or a longer hold, but we want to be opportunistic about being able to hold the company for an appropriate amount of time and do its best, just with our trajectory. So.
It sounds like you're a little more focused on operational optimization as opposed to multiples arbitrage. Is that a fair?
There's a balance, right? What I would tell you is we definitely don't fall at the higher end from a buyer profile of we're going to be those folks, lobbing in bids at, 15 times, things like that. But we've over the years, we've changed our tune a bit to where we'll pay up for businesses where we have really defined views of how to grow them. And so it is a balance, right? I mean, you do have to have some discipline about how you buy these companies. If you can make appropriate add-ons and you have good outcomes for the sellers and use a platform that drives arbitrage, that's great. And then you hope there's kind of a backbone of a good organic growth plan as well. What I will tell you, maybe just to kind of summarize how we look at things, we're never going to make an investment that's predicated upon an aggressive buy and build strategy. There's a lot of firms that do that, and For us, it's just we've seen challenges in it. So
Yeah. Last one, and then we can close out. What is it that differentiates you and causes you to win in bids for these companies over the field?
yeah, yeah.
If you had to point to, what's the kernel of that?
Yeah, I mean, if you take a step back and you look at kind of the culture of our firm, I mean, we've been investing in companies of this size for 16, 17 years, and have intentionally stayed in this size of the market rather than chasing, up tiering funds, things of that nature, to make more money, and management fees, things of kind of that rhetoric, if you will. And we really just relate to a lot of these business owners, and we have a good feel. I mean, what I always say is our job is much more of an art than it is a science. And frankly, it's not a job you can do if you don't enjoy, especially the size of the
Maybe.
market, right? And I think that's kind of at the heart of it. If you ask a lot of
Yeah.
folks we've partnered with, is we're really passionate about helping these folks go out and win and succeed. And
Yeah.
a lot of them care about their legacy. A lot of them care about their people, and they want to know that when they look across the table at someone, it's more than just kind of dollars and cents. And we stick to what we know. We've never misrepresent things, and we work really hard with these folks to drive good outcomes, or at least fail. And sometimes it does happen, but it's always a really honest approach. And I don't think there's any secret sauce or anything that is
Yeah.
completely unique to
Trade
Tecum.
secret.
Yeah, it's just honestly, it's being good people and working hard. And I think if you look at the table, that's how we approach it. And we're not going to win them all, but I think we're confident that if folks partner with us, we've had some really good outcomes, and you know what you're going to get.
Yeah, I'm convinced, without getting on a high horse, that approach to business not only leads to a more comfortable life, but better outcomes financially. And I'm sure that an entrepreneur owner, if they catch any whiff of vigilante, that is a no go.
Yeah, you would think so, but I am always amazed at what people will do for money.
Right. Got to ground this in
You know what I
reality.
mean? So it's you try to
Yeah.
stay the course, but I always say this is the people that have cultural alignment with us are the people that we want to be working with, and those that don't, it's no harm, no foul, and they'll probably find the right partner for
Yeah.
them. So
Great. Well, thanks so much. What is next on the horizon for you personally, professionally?
yeah. So our big thing is at Tecum right now is, just for kind of context to the audience, we have a big growth capital strategy that's been around. That's kind of our legacy business. And we had launched a control equity arm probably 4 or 5 years ago with a single family office. And we recently relaunched our control equity business, with that in-house operating expertise, and really looking to kind of build that strategy out aggressively alongside our growth capital fund, and really kind of bring that partnership of that in-house operating executive alongside an investment team, and to the lower middle market, which you don't always see. So our kind of goals
Yeah.
here the
Right.
next 3 years is, we're going to build out our portfolio aggressively and help our portfolio companies win. And I think evaluate whether or not we move to more of a formal committed fund or kind of stay as more of a opportunistic long-term vehicle. And we're really excited about that. We think it's just a different flavor in the lower middle market, and we like playing here. So that is kind of where Tecum is really focused on right now, is building out
If
this
you had to
strategy.
guess, yeah, if you had to guess in your lower middle market sector, what percent of PE firms actually have true on staff operating partners with deep executive
I'd say
experience?
very low. You might see pictures on
Okay.
people's websites, but oftentimes they're 1099 consultants that are getting paid a fee to be on there. So, and
There's in the stable.
yeah. Especially, I always say kind of that sub like $300 to $400 million fund profile, and our kind of investment criteria maps out to like a $300 million fund. I mean, there is not a lot of folks kind of with that sector or thesis
Yeah,
driven expertise. So we're really excited about it.
that's great. If folks want to get a hold of you, what's the best way, Sean?
Yeah. If you go to our website at tecum.com, my contact info is on there. I'm also on
Okay.
LinkedIn. I'm not on much social media, for better or for worse, but if you reach out through either of those two avenues, you can get a hold of me, and I'm pretty responsive.
Excellent. Well, thanks so much. This has been really insightful. I appreciate your just openness and willingness to share what's working for you, challenges, and so on. Grateful to you.
No, thanks, John. Thanks for having me, and thanks for helping Tecum get their name out there as well.
Yeah, you bet. We'll talk soon.
Thank you all.